Today, I wanted to share with you a trade, and it's very fast. The information that I'm going to give you is important. Okay, and the reason is because this is how I fashion my trades. Primarily to get in and get out as quick as possible. And this is a 7 DTE trade that I put on yesterday. Okay, so you think 7 DTE trade, well, it's going to take 7 days to gain a profit. Well, that's not really true. Usually our 7 DTE trades go for typically 2 to 3 days. This one went for 1 day. Okay, and a little unusual, but it has happened before. But our typical trades go for 2 or 3 days, and we get out at pretty much between 50% and 80% profit. So in this case, I wanted to go over and for those of you who are taking the course, I talk a lot about profitability factors, and in this case, we have a couple. Actually, we had all three working for us today, right? So we had implied volatility, we had market direction, and we had some theta in there. Obviously, 1 day is not a lot, but as you know, the last 5 days of an option's life expire, and it's 100% of the option decay's life, at that point. And so it does decay very, very quickly towards the end of its life, and we use some of that today. Let's go through the trade here. Okay, so yesterday morning, very early, right after the market opened, I went ahead and opened the trade, and it was at 9:48. So it wasn't because I was really looking for 0 DTE, and there was like no premium, and it was very close to the market. And so I was monitoring also to see whether we could put on, because we had dipped, right, and whether we can put on a 7 DTE. Well, you can see here what I have in the chart is I have, and I took away all the other indicators except for a couple here. One is this is implied volatility, okay, this blue line here of the SPX. So it's one of the studies in TOS that you can use, and I've started to use this more readily now, because it's really implied volatility that determines premium price, and not so much the VIX, okay, especially with shorter term options. And so you can see here that the implied volatility was the highest. And this is what I say all the time for 0 DTE, right? It's at the highest at the open of the market. So that's when the highest volatility takes place, right at the open, okay? And so when I saw this dip down, I waited a little bit, and then I saw this dip. It didn't go further down, and this was clearly a reversal here, right? It's a reversal pattern. So I immediately jumped on it and got in, and I had 7 DTE trade ready as well, along with my 0 DTEs, just in case I'd have the opportunity to put it on. Well, I was able to get 40 cents on it. Unfortunately, nobody else in the room was able to get 40 because you can see here how, and this is a 1 minute chart, okay, and you can see here how rapidly the market went up after I put this on. But I told him, okay, it's perfectly acceptable to take 35 on this trade. 35 is a great premium. Don't pass it up. But if it gets lower than 35, don't chase it. Let it run, and we'll have plenty of other opportunities. Okay, so you can see here that as the market started moving up, volatility started trickling down. Okay, and it continued to trickle down as the market went up on here. And let me make this bigger, so hopefully you can see it a little bit better, right? So by the end of the day, we had a nice move up in the market. It doesn't show it here too well, okay? But we were at 3086 around that level, around 3086, okay? And by the time that the implied volatility went down, we had a nice market direction here in our favor. The premium value was already at 30, between 30 and, because I was looking at the midpoint, between 35 and 30, okay, already. Then what happened was, we opened today, and already, as soon as we open, you can see implied volatility here relatively went a little bit higher, right? Because it was the market open, but then it tanked off. And then I saw the midpoint go down to 20 pretty quickly at that point. So we were 20 here. And as the market started going up around this point here, we had about 15. Okay. So it got to about 15 as the midpoint. And I said, okay, we got to take profit here. You know, I mean, I put it in at 40. Let's set a profit target of 15. Well, I set a profit target at 15 right around 10 o'clock in the morning. And as the market continued moving up, it just stayed there at 15. No movement, no movement in that thing. Okay. But you can see here that implied volatility started moving down. And I have the VIX down here as well, just to give you a point of reference. Okay. So the bottom chart here is the VIX. So you can see here, there is some correlation, obviously, to the VIX, right? Because that's really the volatility, the real volatility of the S&P 500, all right? And so as we got down here, we had, I don't know what this flash is down here. It's really not relevant, but this is the open of the market today, right at 9:30. So we had a nice jump up in volatility, and it started heading down. But implied volatility was pretty much the same. Okay, it's pretty much the same and low. I mean, very, very close to 12, in between 12 and 12.5 at this point. So it was about 12.25, and the SPX was about 12.6. Okay, so a little bit higher. Implied volatility was a little bit lower than real volatility. But when I put that signal in to close the trade at 15. Actually, I'm sorry, the SPX, when it opened yesterday morning, it was at 3078. Okay, so just to give you a point of reference, 3078. And so then basically the trade triggered at 10 cents at 11.25 today. Now, the important thing here is I want to show you here that it didn't close at the top of the market when we were at 3102. I mean, it closed at below 3102 at 3100 as the market was starting to go down, right? But you can see that the implied volatility here was the lowest right when the position filled. So implied volatility has everything to do with these trades, right? It's very important to understand that implied volatility is one of the greatest factors of profitability for this trade. So as soon as it dipped here, this was the lowest of the day, 1217, it started moving up again. Okay. And it started moving up, and it continued moving up, but we got out of this trade right at the bottom of implied volatility when the market was starting to go down. It wasn't even at its highest. So it wasn't market direction that filled this trade. It was actually implied volatility that we got a low in that actually filled the trade. And so that's why it's so important to pay attention to the VIX and implied volatility when you're putting on these trades and when you want to get out of these trades, all right? And it would have been perfectly fine if this trade would have continued going. You know, if we didn't get a fill, the market went down, fine. You know, tomorrow it'll open again, and we have decay working in our favor. We have theta in the 7 DTE trade, you know, a lot of it working in our favor. And so whether we got out today or tomorrow or the next day, we would have got a nice profit on this trade. And it just works so well in this kind of environment. You know, if you can pick those times when we have those nice dips, you put them on, and then you just let it ride. You know, because the trade was at we were at 3078. Low volatility, and the short leg was 30.25. And so 50 points, you know, was it 50 points? Yeah, 50 points away from the market in low volatility environment is a very, very safe trade. And no, I didn't want to put on, you know, I've been asked to put on a call credit spread. And the reason I'm not putting it on, because, you know, if you look here, the call credit spread that I would have had to put on yesterday was 30.25, 30.20, right? To get about a 35 cent. It was about a 0.07 delta, and it was at 35 cents that I would have been able to put on the trade. Well, this morning when the market went up, it was already at 80. You know, and if we would have gone higher today, and we could have gone higher, the trigger to roll that trade would have been 3110, 3125, actually 3105, which would have been the trigger to actually for me to roll that trade. All right. So we were very close already for me having to roll a trade if I would have had a call credit spread on it. And it's just not worth it in this environment. You know, it's better to get on these trades, jump in, jump out, make a profit, and do it all over again, all, you know, at the same time. So this is really the primary thing I wanted to share with you, and how integrally important it is for volatility, implied volatility, to be a factor in this trade, and for you to be able to know this when you're putting these on. Okay, very important. All right, any questions on these? Okay, so I don't see any questions. That's all I had for today, and thanks for joining, and hope this was really of value to you. All right, thanks. Bye.